Howdy, everybody. Welcome to Liberty Call. Today is Monday, September 23rd, 2024. Hope you're having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado. Sun's out, no clouds. It is not too hot, not too cold. It is perfect. So, hope you're having a fantastical day. And let's see what happened over the weekend. Astros took 3 or 4 from the Angels. They blew it yesterday, and Alvarez looks like he might have a hurt knee. Not a good thing. Let's see. Most of my football teams won. Well, no, actually they didn't. Last week they all won. The Cougars lost. Texans lost. The Seminoles did win, finally. They didn't go 0-4, which was nice. So, anyways, you didn't come here to listen to a recap of college and pro sports. But anyways, let's, before we jump into the markets for today, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All right, let's get into today's markets. Dow Jones was up 0.15%, 61 points, closed at 42,124. S&P 500 up 0.28%, 16 points, closed at 57.18. NASDAQ up 0.14%, 25 points, closed at 17,973. The VIX down 1.61% today. It's at 1589. Canada up 0.11, Brazil down 0.3, and Mexico up 0.46. In Western Europe, Germany was up 0.58%, the UK up 0.36%, France up 0.1%. Let's see here. Netherlands up 0.2%, Spain up 0.38%, Italy down 0.24%, Switzerland up 0.26%, and Portugal up 0.31%. All right, Russian exchanges, MOEX up 1.28%, RTSI up 0.92%, and then the overnights, the Nikkei in Japan was up, see, it was last open on the 20th, so it wasn't open. Australia down 0.69%. New Zealand down 0.94%. In China, the Shanghai was up 0.44%. Shenzhen Component up 0.1%. China 50 up 0.57%. DJ Shanghai up 0.29%. Hang Seng down 0.06%. And the Taiwan weighted has not been open since the 19th. All right, so that's some good stuff, isn't it? All righty, well, let's get on over to the weekly economic update. Stocks moved higher last week after the Federal Reserve's half-point cut, bolstered by multiple data points supporting a cooling but still strong economy and decelerating inflation. Well, the real reason was we got an election coming up in, 6 weeks, something like that? And just like Chairman Powell was very accommodative to President Trump in the end of 2019 going into 2020, and then all the cash and printing that they did during the summer and fall of 2020, he had his fingers crossed, his toes crossed, his legs, anyways, I'll keep legs crossed out of the anyways. I have to imagine the administration was being accommodative to him. They're doing the same thing now for, who is running things? I mean, is Biden actually alive? I mean, I have to wonder. I mean, I've seen him roll him out, someone who looks like him, but it could be a dude in a mask. So I don't know. I mean, I imagine the administrative state really is running the government at this point. We've lost control of things. All right, let's get back into this. The S&P 500 last week gained 1.36%. NASDAQ rose 1.49%. And the Dow Jones moved up 1.62%. And overseas were up 0.42%. Fed cuts rates 0.5%. Stocks traded in a narrow range for the first half of the week as anxious investors awaited the outcome of the FOMC's September meeting. Shortly after 2 p.m. Wednesday, the Fed announced it was cutting rates by 0.5 percentage point, a more significant cut than some investors anticipated. Stocks initially rose in response, then fell. Some market watchers attributed the decline to concern that the Fed might be concerned about economic growth. But after sleeping on it, stocks rallied Thursday with the NASDAQ and S&P and Dow climbing 2.5%, 1.7%, and 1.3% respectively. The Dow topped 42,000 for the first time, while the S&P 500 crossed the 5,700 mark. All right, so the Fed's move, a half-point cut was the first change in the federal funds rate in 14 months and the first reduction in 4.5 years, bringing its target range to 4.75 to 5%. Fed Chair Powell said the decision reflected the committee's greater confidence that inflation is moving substantially towards the 2% and that the, quote, risk of to achieving its employment and inflation goals are roughly in balance, end quote. Yeah, I was listening to Peter Schiff's podcast after the Fed announcements over the weekend. And his podcast was like last Thursday, but I was listening to it over the weekend. And, he kind of echoed a lot of the same things that I've been saying for a while. It's like, well, why do we have to cut rates, or why should we cut rates if the economy is running great and inflation is still above your 2% target that, you've pulled out of thin air, that, everything's got to get 2% more expensive every year for some stupid reason. But since it's, when inflation has been below 2%, they'll let it go over for a while, saying, oh, well, it needs to average out over, say over a 5-year period. We need the average to be 2. But when it's like 9%, like it was, what was that, 2 years ago at one point, they never say, well, we need to have negative interest or inflation for a while so that it, over time, say on a 5-year average, moving average, we average out around, around that 2% mark. But they never do. They say, hey, well, it's getting close. So let's go ahead. Hey, the mail truck's here. And there's some deer in my front yard. Cool. Anyway, so yeah, it's when it starts to get, oh, well, we need to start cutting rates. So anyways, that's my soapbox. All right, economic data this week, Monday today. We have Fed official Raphael Bostic, Austin Goolsbee, and Neil Kashkari are speaking. Tuesday is the Case-Shiller Home Price Index and Consumer Confidence. Wednesday, new home sales and the EIA Petroleum Status Report. Thursday, we have gross domestic product, probably the final number for Q2. Durable goods, Fed Chair Powell speaks, pending home sales, Fed officials Michael Barr, John Williams, and Neil Kashkari are speaking, and the 7-year Treasury note auction. Friday is the personal income and outlays, and also international trade in goods and consumer sentiment. Just a few major companies reporting earnings this week. Tuesday is AutoZone. Wednesday is Micron Technology and Cintas. Wednesday is Costco Wholesale. All right, so that's the weekly update. Y'all feel smarter out there? There's no one watching right now, so probably not. All righty, let's get into the market recap. Wall Street rises after Fed policymakers back rate cuts. That's wrong. My wrong notes there. All right. On Monday, Wall Street major indexes rose as investors evaluated the Federal Reserve's recent rate cut and its potential long-term effects. Following the Fed's decision to lower interest rates by 50 basis points last week, markets have been assessing whether this marks the start of a broader easing cycle. Fed policymakers Raphael Bostic, Neil Kashkari, and Austin Goolsbee, the dumbest human on the planet, voiced support for further rate cuts this year, adding to speculation about future monetary policy, despite Governor Christopher Waller's comments on potential inflation undershooting the Fed's 2% target. Trader bets for a larger November rate cut have fluctuated. Markets now expect a 74 basis point reduction before the end of the year. So I guess what they're saying is probably another 0.25% between now and Jan 1. U.S. business activity in September remained stable, but prices for goods and services rose at their fastest pace in 6 months. That cooling inflation we're talking about, potentially signaling rising inflation. Investors also are waiting to see whether the economy will experience a, quote, soft landing, end quote, avoiding a major downturn. I doubt it. 8 of the 11 S&P 500 sectors saw gains, led by consumer discretionary stocks, while healthcare stocks fell slightly. Rate-sensitive stocks like Tesla surged 4.5%, and Meta Platforms gained 0.65%. Intel rose 3.41% following news of a potential $5 billion investment from Apollo, while General Motors slipped 2.31% after a stock downgrade. The upcoming personal consumption expenditures data for August, the Fed's preferred inflation gauge, is expected to be a key driver for the markets later in the week. All right, so there it is. All right. Next up, we got from First Trust, Mr. Brian Westbury's Monday Morning Outlook. This week's article is titled The Budget Blowout. So let's see what he had to say. The U.S. federal budget deficit for fiscal year 24 is projected to be around 1.9 trillion or 6.7% of GDP. This figure is unusually high outside of major wars or recessions. But by comparison, the deficit in 2012 during the recovery from the Great Recession was similarly large, but the unemployment rate was much higher at 8.3% compared to 4% today. Even during the Reagan era, when deficits were criticized, the highest deficit in 1982 was 6% of GDP, but this occurred amid a recession and Cold War military spending. Yeah, good old Ronnie had to, I think he wanted 800 ship fleet in the Navy. I mean, by the time I got there in 93, by the time I got into the military, it was a mess. Stuff was falling apart. I mean, the bases were just, from what I read today, they're even worse. I read about young sailors on like Reddit and such that they got like mold and stuff growing in their barracks rooms and stuff on the air stations. And it's gross. I mean, our barracks, the barracks I lived in was pretty nice. It had been built probably in the 10 years before I had gotten there, so it was relatively new. Some of the older barracks, the first barracks I lived in when I got to my duty station at Cecil Field, it was probably built in like the 40s or the 50s. And then somebody got crabs and it infested the common bathroom, or head as we call it. And so you had to go either upstairs or downstairs to take a shower or do your business for, I think, like 2 weeks. And the main culprit was one of my friend's roommates down the hall. And, I think there were 3 or 4 beds in each room. And, you go and you sit on everybody's bed, and he spread it to everyone in the room. So, oops. So anyways, where was I? Oh, gosh, I got off war spending. What's remarkable is how much the fiscal situation has deteriorated in 5 years. In 2019, before the pandemic, the deficit was 4.6% of GDP, despite revenue rising from 16.3 to 17.2 of GDP in that period. The deficit has widened. Revenues have increased by 1.4 trillion since 2019, but the key problem lies on the spending side. Shocking. I know the idiots in Washington just continue to spend money that's not theirs, or that we haven't even paid them or contributed in taxes. 3 factors contribute to the rising deficit. Net interest on the federal debt, which has grown 1.8%, or from 1.8% of GDP in 2019 to 3.1% this year. Increased other mandatory spending, particularly due to student loan forgiveness. And 3, rising costs of healthcare programs like Medicare and Medicaid. Again, I should not be paying for healthcare of other people. I only should be worrying about myself. The structural changes in the budget, particularly related to spending, are becoming more pressing, and addressing them will likely be a major theme in future administrations, as low interest rates are no longer shielding the U.S. from fiscal difficulties. All right, so it's a mess. I mean, personally, I don't think anyone's going to fix it. There was a time, like when I was 18 back in 1992, the first election I voted in, and I was a big Ross Perot guy. I really liked his, approach and granted, he could have been just as bad as everybody else. Every president in my lifetime has been a piece of crap when I've gone back and actually looked at the real history of things. Not the crap, the stuff you get from CNN and the news media who, glosses, it's like the 2 Bushes, Papa Bush and, W. They were like war criminals. Everybody hated them, especially the left. And today, they're the greatest people ever. When in reality, Papa Bush was a scumbag, and his son, wound up killing how many millions of people in Iraq, and how much blood and treasure of our own here from the United States has been wasted in that desert. So anyways. All right, got one more article here coming from Zero Hedge. The Fed's last sign of independence may be gone. This was authored by Daniel Lacal. In his analysis, Daniel Lacal criticizes the Federal Reserve's recent decision to cut interest rates by 50 basis points, despite claims of a solid economy. Again, basically what I've been saying. Why are we doing this? A strong job market and a no risk of recession. Lacal argues that the Fed has consistently ignored warning signs of inflation and monetary mismanagement, breaching its price stability mandate for 3 years. The decision to lower rates, Lacal suggests, is driven by a need to support the U.S. government's growing fiscal irresponsibility rather than addressing genuine economic concerns. He points out that financial conditions remain loose and questions the Fed's decision to cut rates when inflation is still above the target. Core CPI remains high, and there are no clear signs of an imminent recession. Lacal argues that the Fed is bailing out the government, which is grappling with a massive budget deficit of $1.897 trillion in the first 11 months of 2024's fiscal year, and rising interest costs on the public debt. It's going to be glorious when it falls apart. I mean, watching all these federal employees lose their jobs is going to be hysterical. And how am I going to eat without the American people paying for all my stuff? Lacal suggests that the Fed's actions, including slowing its tightening cycle and reducing its monthly Treasury redemptions, are aimed at lowering Treasury yields to ease the government's debt burden. However, he warns that this will only worsen the U.S.'s fiscal problems, erode confidence in the dollar, and harm real wages and small businesses. Ultimately, he concludes that the Fed's prioritization of government debt over price stability could lead to a long-term stagnation and undermine the U.S. dollar's status as a global safe asset. Well, we know that's not the case anymore. I think I showed a chart. Let's see if I can find it. Showing, excuse me. Let me go to my page here on, here we are. We don't want to look at some of the stuff I share. Anyways. Yeah, this was, this is, here, let me put this on the screen here. This is ounces of gold to buy the average home going back to like 1969. And so, in the early 70s, it was about 700 ounces of gold to buy the average house. And then by the early 80s, it had fallen to just over 100. And then it peaked out again in about 2000 at over 700 per ounce, bottomed out in about 2011 between 100 and 200. And really since then, it's been between 200 and 300 ounces of gold to buy the average home. But what do we know that has occurred over the last, 4 or 5 years? Home prices have gone through the roof. So let's go to my next chart here. This is ounces of silver to buy a home. So, starting out same time, gold and silver prices obviously fluctuate, but, you can see kind of bottomed out here again around 1980, peaked out around a little after the 2000s at about 50,000 ounces, bottomed out again around 2011 after the housing bust at under 10,000. And it's kind of been, just above or below the 20,000 ounce of silver for going on about 10 years now. So again, home prices have not, really been jumping around too much. And yeah. And then also if you were to do it on barrels of oil, how many barrels of oil? Again, it bottomed out, in the early 80s, peaked in around just before the 2000s, bottomed again around 2011. And again, oil is a little more volatile than other things. But anyways, that, prices have really, prices of goods have frankly been fairly stable the last 10 years when you compare it to another asset as opposed to the US dollar. So, if you were to price things in gold or silver, you'd have a lot more stability. And so that's where, I personally don't think the US dollar will be around in a decade. But again, I could be completely wrong. We could have some really smart people come into Washington in the next election and fix everything. I know. I couldn't even say that with a straight face. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can get all your financial planning needs assessed and taken care of. So feel free to give me a buzz. I'd be happy to help. All right. Well, that's everything that I had for today. Like I said, if anyone needs me, go to the website. Otherwise, have a fantastical evening, and I'll talk to all y'all again next time. Adios.